oil prices are roaring on to $80 a barrel, it would appear. So let's kick off, as always, with Christof Rühl, Senior Research Scholar at the Center on Global Energy Policy at Columbia University. Christof, in my absence last week, there seemed to be some turmoil with the Evergrande real estate debt default threat out of China. It seems to have passed and the markets have reared on. Your thoughts on the hangover from Evergrande, is it over?
Good morning. Yeah, that happened while you were gone and I was in Dubai, but I missed you.
Yes, right.
So you shouldn't leave. Yes, that particular instance seems to be over, but as ever, there are high walls to transparency, so we cannot be sure. What's not over, however, is the return to normal, including the dark sides of normal in China. As I think we've discussed many times here, when you think back then before Corona, to this intelligent sentence, Corona sort of made all existing trends stronger in the main. Before Corona, Chinese growth was slowing. The shift to the service sector was slowing, and the political centralization was tightening, and there were big worries about financial instability. So then comes fast forward Corona and all this movie, and now where we are is sort of in a return to growth even slower than projected before. The political campaigns getting really sort of a bit on the extreme side and all-encompassing and a bit to reassert control in this strange, liberalizing more markets means more decentralization, then political control means more centralization. And their first open signs for financial trouble. I just want to remind everyone that there is no example of an economy successfully going all the way from heavy industrialized economy to modern market service-oriented economy without going through financial crises, which is why I tend to agree with many economic historians who say China will not be an exception to that. Sooner or later it will happen. And we seem to be getting more into a fragile situation as the economy develops and as the race between centralization and decentralization, market and politics tightens.
Let's welcome Maleeha Bengali, founder of MB Commodity Corner. And as the internet gremlins are dealing us a bit of a blow this morning, she is not on camera. Maleeha, good morning. The other clarity we seem to be wading through the mud of the Fed. Are they or won't they ever get to tapering? But last week, Fed Chairman Powell seemed to give the strongest signals yet that indeed they are not going to be knocked off course. They will proceed with tapering over the winter. Your thoughts?
Thank you, Sean. Yes, last week that took center stage. What's interesting is what Fed Powell didn't say versus what he did say. The message was definitely hawkish. They are on track to taper close to November. It's important to keep in mind that they have two main objectives, employment and inflation. Inflation has clearly met their goal above and beyond. Employment is still lagging because obviously the last jobs report was actually a lot lower than expected. The Fed needs to see 1 or 2 months of strong payroll job growth, especially after the government's ties are over to then go on with the taper. Having said that, even though the message was hawkish, this last week, the Fed increased their balance sheet yet by another 45 billion. In the last 2 weeks, they've increased the balance sheet by 130 billion in 2 weeks. So the Fed is doing QE in the back. End of the story, we still have net liquidity injections as opposed to reductions, even though there's talk of taper in November. And the market will not fall or cannot fall, at least the S&P 500, till that balance sheet doesn't come down. And I think that's what's important to keep in mind. If the payroll numbers we get for September, October are not as strong, we feel that the Fed actually may not taper. They may not need to taper. So the market's still a bit undecided on that.
Christof, your thoughts on that? It does seem, listening to some of the sort of commentary after last week's announcement, was that it's no longer if they'll taper, but how quick, and then consequently, how quick do interest rates then become the next front line?
The Fed has a bit of a credibility problem to conquer in two fronts. One was this very early announcement that no, we will not be inflationary and we'll all be under control. And for the Fed, I think, unexpected huge wave of criticism which came from the markets, from economists, from some politicians, and so on. So they have to show that inflation really doesn't sort of lift above target durably. Although in their heart of hearts, they probably would like inflation rates of 3-4%, much more than their target of 2%. And then the other credibility problem they have, that was sort of manifested with their review when they gave themselves not only the old, which they had before the employment target, but all this color around it, that really it should be a red hot labor market. Everybody should have a job. and all of this, is the criticism of asymmetry for years now, since at least the financial crisis 2008. The Fed seems to have had a bias. When the economy was weakening, when markets were only threatening with becoming a bit weaker, they were quick to ease and to buy bonds and to leave interest rate low. But when the economy was getting stronger, they were very slow in tightening up and adjusting. And so that's the reason, I think, why Powell didn't want to have another discussion in a perverse sort of way. This kind of credibility problem even makes them to probably, at least verbally, pronounce the advent of tapering longer than they would have to do otherwise, because they need to convince everybody, yes, we mean business. My take is they still do mean business, so any catastrophes, especially from China or elsewhere, not excluded, they will start taper this year. And the buffer they have is between tapering, which can be like chewing gum, you can scale it up and down forever, and actually having to become active on interest rates, which is so much harder not to crack, and which would be much harder to reverse. So my take is they will start tapering rather earlier than later. November will remain in the cards. And then the interest rate thing is that where they can delay a little bit, and where they will show that their asymmetric response to economic headwinds again, which ultimately will result in higher inflation rates.
We did finally see the first interest rate move. I believe it was Norway last week who were the first developed economy to in this cycle. New Zealand, as we know, a few weeks or months ago, stepped back from that decision. Seems Norway is the first to move. We'll see what happens from there. Maleeha, your thoughts on all things China? We've had the obviously the Evergrande issue lingers there. Is it still a threat of contagion? But also we're seeing China facing power cuts and wider, amongst the shortages in gas and other challenges. Where do you see that sort of a cumulative challenge to China with the victory over the weekend of bringing home the CFO of Huawei?
Okay, so China basically since November of last year, as you've discussed, has been sort of in a deleveraging mode. We've seen that in the negative Chinese credit impulse data, which takes about 6 months to show up in our data. And we've seen prices collapse. So we know China's been in a slowdown mode. What people don't know is that when they slow down, they probably slow down a bit too much. And you see them all the PMI numbers and the ISM numbers. The slowdown is in fact real. The Evergrande situation is up for debate. Obviously, it's a bit contained. I think the proposal is going to be a lot more domestic solution as opposed to a foreign solution. As you've seen that foreign debt holders are not getting their coupon payments. So China is going to keep it very China specific. What's interesting also is that they start injecting liquidity again. We feel that towards the end of this year into next year, because they've probably fallen below trend growth, they're going to inject liquidity and to get that back above. So I think we feel that the deleveraging is over. They're not going to go on a massive stimulus spend, but we think there's support and stability coming to the market, which is why you've seen copper prices, bounce a bit as well. The markets have bounced a bit. So there are sort of two things happening, and we feel China is obviously going to support the market from a stimulus point of view in the very short term.
Christof, the UK, quite spectacularly facing shortages, queues at petrol stations, this wider issue of shortage and supply chain congestion. Which is it ultimately on the energy side? Is it supply chain, bottlenecks, or are we really looking at shortages, do you think?
Yeah, that must have made you smile when you saw that from Ireland. Now they say they want to hire 100,000 truck drivers from the European Union, and those truck drivers.
What's Brexit?
The truck drivers say, "Thank you very much. We are needed everywhere." Yeah. So the bottlenecks, the shortages don't go away. In the energy space, it is a curious mixture. It's clearly on the supply side. I think it's shortages on the supply side. To a large extent, they are indeed the echo of what happened in 2020, when everybody scaled down production and didn't do much investment. But this is exasperating. And when you had, LNG, for example, it's a good example, and prolonged maintenance periods, situations in the US, where large agglomerations from workers were outlawed for a while under the lockdown, so they couldn't proceed with getting LNG trains ready, where you need literally thousands of people there, and these kind of delays. But on top of that, you also have political factors. So you remember the spat between China and Australia on coal, and you have the whole Nord Stream and situation in Europe with Gazprom, Russians getting annoyed at what they thought was American interference in the gas markets. So that political stuff also plays a role. And then you had accidental forces from the weather side as well. Corona winter 1920 turned out to be much colder and much longer than average, and that also had an impact on gas prices. Now, I'd like to single out two fuels because they are different. One is oil, where clearly the cycle, we also have now one supply disruption after another explaining why prices go up so much. But the rise of prices in oil in the big picture, that was a managed process by OPEC, as we all know. So that was different from coal and from gas and from commodities and metals. And the other one I would single out as different is natural gas, because natural gas has also two other key features beyond these day-to-day disruptions. And one is that this is a fuel which is in the midst of globalization, of global integration. As the share of LNG goes up and the share of pipeline delivery goes down, and therefore the long-term fixed pipeline contracts disappear, and an integrated market develops, where tankers can be redirected from the middle of ocean from port A to port B because prices have changed. And what we're seeing is the typical cyclical sort of birth pangs of an industry which globalizes and is huge and capital intensive and large indivisibilities and all these things we know from other commodity cycles and from oil. And the second one is, of course, the link to the energy transition, which is also clearer in the power and in the natural gas markets than in any other fuel market. And by link, I mean high carbon pricing adding to the malaise, shutdown of coal plants in Europe adding to the malaise, all these things. This discouragement of investment and the singling in on renewables and with neglecting the intermittency problem, especially in Europe, which came sort of in the run-up to COP26 and with the proud label of we're going to be carbon neutral. What we are seeing here is only the beginning of a huge bill coming in, and that bill will be large enough to do, I think, derail this whole understanding of an energy transition as we currently have it. It won't be this smooth process of substitution which pays for itself and generates green jobs and all of that. It will be a terribly hard slog, very expensive, and people will get annoyed about it.
Maleeha, I just would like to explore a little bit more your thoughts on the potential that tapering does not happen. What are the ingredients that would feed a decision for the Fed to back away from what seems to be a growing commitment?
Okay, so in terms of the two situations where we feel tapering cannot happen would be if we see a much slower growth in employment growth in the US. We see job payroll numbers coming weaker next week for September. There's a chance the Fed obviously is going to hold back. But if you get two really bad prints, we think the Fed might be forced to maybe delay tapering into December as opposed to November. At some point, tapering gets to be a bit irrelevant because even if they do it, I think they might start between $5 and $10 billion per month, but there's also a net liquidity injection coming in. We also have the fiscal bill. We have midterm elections in the US, and we actually get this $3.5 trillion bill passed, and obviously that's going to offset some of the monetary weakness. So we need to put everything in context in terms of global liquidity. The liquidity balance, once we see a net reduction, that could be bearish, but we don't see that net reduction happening right now. In fact, the market is going through a growth plateauing phase, so it's obviously it's leaning over commodity prices, industrial commodity prices. But if we start seeing net liquidity supportive, that can actually support prices. Now, this liquidity is actually having a different impact on different commodity prices. What's going to happen in copper and iron ore and oil is very, very different. It's not just one sort of rising tide lifts all boats scenario. So one has to look at specifically into demand supply metrics for oil or copper and dictate which one actually will be performing based on the inventory balances.
Do you think that the markets have already digested tapering? It seemed it had fairly little impact last week when the stronger signals emerged. As the markets, the financial markets, equity markets moved beyond tapering, do you think?
No. So basically, the market was very much expecting a tapering hawkish announcement, which is why when the statement came out as hawkish, the market rallied. The S&P rallied 1.5%. The dollar actually, sort of fell. Gold rallied, Bitcoin rallied. So the market actually was a bit pleasantly surprised by the hawkishness of what he said, which is quite interesting. So I think the risk is right now if they delay tapering, not actually do the tapering. The market's pricing in tapering for November right now. So as I mentioned, if you get a weak payroll number, I think the market might just sort of take it as, okay, the dollar will fall more, the market will be supportive, and the markets rally. The pain trade we feel is more to the upside. Everybody seems extremely bearish in terms of liquidity, tapering, growth, China, Evergrande. It's like maximum bearish sentiment in the markets right now.
Christof, of course, today we have the German elections, of the most important political leadership in Europe, at least has been the case. Your thoughts on where the election is likely to go and how significant it is for markets and macroeconomics in general?
May turn out, so this is a picture which looks extremely stable from the outset, as probably Germany has for the last 50 years. too stable, many would say. But there is the potential for quite some change underneath, which will become apparent only over time. And this is, again, because Germany, when you step back, traditionally always had coalitions, had two large parties, a socialist or social democratic and a conservative one, of which Merkel came, and a small party, and then there was always a coalition because one of the two large ones and the small one. That's the post-war picture forever. This time, all the big parties, the both of them now have evaporated and are down to the 20% range. So for the first time, we will get a coalition between three parties. That's the first sort of new thing. But secondly, it seems clear, if the polls are to be believed, which these days is a big if, but if the polls are to be believed, it seems clear that two out of the three partners are already known. And these are the Social Democrats with this guy Scholz, and the Greens. The Greens with much disappointed expectations of about 15, 16, 17%. The Social Democrats surprisingly uplifted for them in the lofty heights of 25, 26, 27%. And Merkel's Conservatives in between with about 20%. So it looks as the Conservative parties out. The Social Democrats, the Greens will form a coalition, but they may need a third partner. And this is the most important thing which will develop. This additional partner could be the left party, which is mostly fed from people in former East Germany, which is a true sort of hardcore socialist party at least, or it could come from the market liberals, the so-called liberal party. If it comes from the left party, then you would have a red-green coalition, so they call the Ampel coalition also. That would stand for higher taxes, for more bureaucracy, for much stronger central administration, and for just a very traditional socialist, social democratic policy. Limiting income spreads would be a big topic. Climate change would be a huge topic, these kind of things. If it becomes a coalition between the Social Democrats, the Greens, and the market liberals, it becomes, in economic terms, a bit more sort of on the market side, but it will also be fraying much earlier because tensions within them would be very large. So the compromise position may often be very often be not to do too much. So you step back, and under both scenarios, this Merkel picture, which was the quiet hand guides the country in the positive sense, but stagnation and sclerosis and nothing happening in the negative sense, that second part of it, that nothing much happens, so that at least whatever happens goes more into bureaucracy, administration, centralization, seems to be the likely outcome under both of these coalition prospects. And the first one, because that's in the heart of the participants, and the second one, because tensions will build up, which will block any real change. And so not much will happen. That's not very good for Europe in this current situation.
Did we see, or was there any impact of the recent decision by the UK, US, and Australia to create this security pact and exclude Europe? Obviously the French got very upset. It seemed Germany sort of ignored it.
Yes, I think that was the attitude. There was a bit of a bewilderment towards the French, why they suddenly got so. I mean, it's very funny because the UK, the US, Australia, New Zealand, Canada, and somebody else, it's I think six, have this 6 eyes compact, where the security services are sharing information with each other, but not with the rest of the world. And so where was the French and the German security services not realizing that this was going on? That was one reaction here. And the other one is that, take it on your chin. I mean, this is just to be expected. The skepticism towards the US has grown so much here under Trump. It's very hard for Biden to remove it, and these actions will not help.
Let's go to the survey question before we sort of look to week ahead. Oil prices rose for a third week in a row to a near three-year high on Friday. My question is, has the Evergrande debt crisis passed as a threat to markets, as a threat to global markets? The big contagion issue that was clearly hanging over the market a week ago, has that now passed? Yes or no? Welcome your views on that before we look to the week ahead. Maleeha, your thoughts on what will be grabbing your attention this week? We have the German election. We just had the Iceland election yesterday, for whatever that's worth. We've got sort of China woes still lingering. Your thoughts week ahead?
Week ahead, I'm looking for obviously the non-farm payroll growth on Friday. That'll be very important for the markets. Any more commentary, obviously, from Fed members would be interesting. We're also taking a look at October seasonality, which is very interesting because usually September has quarter-end, month-end flows from asset allocation, pension funds that distort true fundamentals. So we'll probably see a lot of violent, extreme moves into September. We'll be looking past all that noise. So that'll be interesting setup into the Q4 trade. So a few sort of macro factors we'll be keeping an eye out on, and obviously see how the government production, oil shortage, all resumes itself. But more on the macro side than the micro side is important this week.
What are your thoughts at these days, Maleeha, on the sort of what is now feeling like a bit of a broken record argument? Is this inflation temporary, or is this inflation embedded in? Is there any strong signals emerging to anchor either one of those two arguments?
No, inflation is definitely not transitory. I think the Fed has sort of come around to that. If you break the numbers on the CPI down, some of the more stickier measures, the shelter, home prices, some of they're actually going up a lot higher. So we feel inflation will stay a lot stronger for the next 3 to 6 months at least. Eventually, they do have a longer and tapering of expectations of inflation, but for the near term, given the supply shortages, the demand pull, we think inflation will be a lot higher, which is actually the Fed's Achilles heel because they're getting their vision on the inflation side. The problem is growth. So right now, we're sort of in a stagflationary environment, which is spooking markets, but we need that sort of demand pickup to offset the inflation not being transitory for right now.
Christof, we have oil closing at the end of the week and having broken through to a new high on Brent. Is there anything to stop it from getting to $80, do you think, maybe even this coming week?
Yeah, I may have to eat my words on the oil price spikes, but what would stop it is a return to normality, stop of these relentless kind of flow of disruptions, of hurricanes, of all the things, the outages we have seen. But it looks as if now the lasting damage from both hurricanes still is such that the US inventories may draw again. It looks as if demand in the US is strong enough for them to keep them from drawing, and that would probably be enough to get it to 80. But the fundamental picture, of course, is one with too much oil. We see the rig count reacting. We see all these price mechanisms kicking in. So sooner or later, it will spike. It might spike, quite a lot, and then come down quite a lot. So volatility in the cards here, I think. And it seems to be very much now driven by what happens in the US, because there isn't much support coming from the Chinas of this world anymore.
One of the issues I pointed at earlier in the month when we were discussing the supply shortage is OPEC plus the supply shortage challenge rather than elsewhere, in the sense that we've got a number of countries struggling, it would appear, to meet their existing quotas, most spectacularly Nigeria, Angola. What is your outlook for that, where OPEC plus struggles to sort of bring back or meet this new supply target of even 400,000 barrels a day per month?
It's real. So one of the persons I had spent some time with and heard talking is the MD of the Nigerian Petroleum Company, and he was doing his level best to avoid this topic. And so it is. There is some reality. I was often thinking about. Remember when we said at the time, in oil, it's all politically that the prices went up and should leave it to the market. Maybe it would be steeper, would also come up. That's what we see now in other markets. That markets would have brought it up as well. But I think that OPEC plus, yes, outside the Gulf, so is already at the borderline of what they can do. I think that includes Russia, Kazakhstan, these guys who never really cut in an obvious sense very much. And so it is up to the picture of having a reserve capacity in the Gulf, which will sort of call the shots. And when I look at what I hear from there, they're in no mood of saying that the world really needs prices below 80. I haven't heard that yet. So yeah, we should expect that this continues. So.
There doesn't seem to be anybody screaming of pain, and the Indians who typically were leading the pain barrier on $60, if my memory goes back correctly. Maleeha, back to your thoughts. Just want to get sort of closing views on that. The may not taper argument. The idea that we could see, just on that point, with OPEC plus shortages or inability to meet, that there's a lot of expectation in the market that OPEC plus can just simply bring back all of this oil that is sitting on the sidelines, but there could be shortages there. We've got shortages in gas. Clearly, the threat to economic recovery over the winter might be energy shortage, and hence another reason why the Fed may back away from tapering, although not in the US is this problem, but elsewhere.
Right. So basically, we have to keep an eye on US domestic oil production. There's a lot of talk about, obviously, shale from last year. They've not recovered. They have this tough promises to the shareholders to return capital back. At some point, the question we're asking ourselves is, when does it start
I think we
twice
lost.
limit them to start
I
drilling
lo-
more. We'd be interested to keep passion growing.
Sorry, Maleeha, you're cutting in and out there. I don't know if the line that you're
I'm
struggling
sorry.
with.
Yes, I apologize. I have really weak data here. So in terms of, we have to keep an eye on US domestic
Okay, we're going to jump from Maleeha because we're getting bad signal. And let's get
oil
the survey
production to see what
results. Sorry,
shale will do with these prices.
Maleeha, we're
There's a lot of
losing
talk
half
about
of your
them
commentary.
increasing.
So let's just get the survey result in. Has Evergrande debt crisis passed as a threat to markets? Yes, 2-1. Christof, you give us closing thoughts and welcome also your insights on Iran. There's been a bit of noise over the weekend. Will Iran talks come back? How quickly? If they're any further delayed, it's going to be, in essence, the end of the talks.
So there's a number of hotspots emerging now. You mentioned one, which is the impact of energy prices on growth. And of course, the impact of energy prices on inflation, in particular in Europe, and what that does to central bank policy. There is political hotspots emerging. After the German elections, you will have to see some very swift action on certifying Nord Stream 2, with the Russians and the Germans probably declaring victory over US sanctions. So that could be making it a bit more difficult to normalize the transatlantic side. And it falls, of course, in debates in the Ukraine and all of that. And there's the third one, the Iranians sort of trying to find their way back into normality, and Biden trying to deal with it. And more than anything, I think it's worthwhile now looking at the US, because the Biden administration seems to have got stuck on several fronts. And I wonder what they do next to keep the ship moving again. And I can't imagine that it would be something in favor of green energies, restricting this access on supplies at home even more. And all of that happens in the run-up to COP26. So it seems to become all of a sudden a world where some of the shifts continue into the winter, and energy is very likely to remain front and center, especially also outside the oil markets, with these high natural gas and power prices everywhere, which really are a threat to industrial production, to the competitiveness of industrial production, both in Europe and in China.
Well, we will wrap it up there. I think as weeks go on, maybe there's nothing to stop the $80 handle being knocked up, and that will make the next Jorge Christof Sunday show even more exciting. But ultimately, it does appear to me that U.S. election cycle starts to rear its head, and the ramifications for that, how they vibrate into these markets, will be one to keep an eye on. Heads up, this week we have this is APEC week in Singapore, the S&P Global Platts annual conference, which of course is a mix of blend and virtual, given the world we're living in still, particularly in Singapore, where they're going into another lockdown with higher infection rates. But this week we're going to be doing a virtual workshop as part of the APEC week on all things related to Fujairah and its role coming out of the post-pandemic cycle. Welcome everybody to that. You can click in to register on LinkedIn pretty easily. Christof, as always, thank you so much. Maleeha, sorry about your technical challenges, but we got 99% of what you said through the half hour. So thank you very much, and we look forward to having you back on air in due course. Best of luck to everybody. Week ahead, and make luck. We'll see you every morning, 10:30. And on the comeback is to extend a great thanks to Vanda Nahari of Vanda Insights out of Singapore. Tremendous analyst and tremendous substitute last week. Thank you, Vanda, for that. All the best, everybody. Thank you.
Okay, bye-bye.
Welcome back.